Okay, afternoon or good morning. I don't know where you are in the world, but for me it's afternoon. Just first, we're going to get this out of the way. We're going to go through the contract rollovers. So, what is a contract rollover? Well, in futures, we trade contracts rather than cash options like US 100 or Nasdaq 100. We trade Nasdaq futures. Now, each futures contract that we trade is going to have an expiration date. So, for NQU 2025, as you can see here, it says September 25th. I'll show you the website in a second, but that means this contract is valid until the third week of September 25th. Now, which part of the week? Generally, you're going to do like the second or third day, but to use it precisely, you're going to go over here where it says open interest, and when this number of open interest is higher than the next contract, which is NQZ 2025, then you would switch over contracts. So right now, the open interest, and open interest just means the amount of open positions, so the amount of contracts that are currently in the market. On NQU, we have 273,905 contracts in the market. On NQZ, we have 42,000. And then after that, you can see the number drops off completely. Whilst we're rolling over, the number from here is going to start reducing, and it's going to start increasing on this one. When the amount of open interest on NQZ is higher than the amount of open interest on NQU, that is when you're going to switch over to the NQZ contract. How do you see this? Like what I've got here, this information. If you go onto barchart.com, you click this, select the commodity, and then you select Nasdaq. You have to scroll down a bit. Or NQ mini, E-mini futures. You'll have the cash. We're not using the cash. Again, we'll do futures. Then you have the current contract month and the next one. So there's four contract rollovers every single year. You have from December to March, from March to June, from June to September, and then from September to December. And then you reset again. So in the third week of the expiration month, this month here, where it says September 25th, or September 2025, that's the expiration month. So this contract will expire in September 2025. In the third week, which is the current week that we're in, usually it's going to be the first, second, or third day where the open interest is going to switch, and it's going to be majority on the next contract. So that will just help you with knowing which contract you should be trading and which contract to be looking at, and it also explains why you'll see some or a lot of gaps in the market. So if we go here, in Asia, for example, we had a lot of gappy price action. That's because the open interest is transferring now into the other contract. If I go to NQZ 2025, you can see that we're pretty much looking at the same thing, but the price levels are not going to be as accurate on here as they are on NQU. And that's just because the open interest hasn't fully transferred yet. Okay, morning everyone. And then now let's look at the economic calendar for the day. So today we had 8:30 medium impact news, Empire State Manufacturing Index. This is rubbish, it doesn't do anything. It's basically no high impact news at all. So you'll expect more of a consolidation day. Oh, I took Friday off. Whoops. Let me find that screenshot again. Just a second. Okay, so Monday we had no high impact news, and the Empire State Manufacturing Index does literally nothing. Tuesday we've got a high impact at 8:30, core retail sales. That's one to look out for tomorrow. And then Wednesday, we have news in the PM session, so there's nothing at all until the PM session. So we'll probably get a consolidation day into New York PM reversal. I think that's covered in lecture 4 of the ICT 2024 mentorship. So you can check that out. It's FOMC. You don't really want to be trading FOMC. So that's not a day to completely avoid, but it's a day where you're not going to have the best levels of price. Less algorithmic, lower probability. Thursday's good because after FOMC and we've got unemployment claims. So we know from looking at the economic calendar that the majority of our volatility is going to come in the later half of the week, Wednesday, Thursday, and Friday. That means that on a day like Monday, when there's no high impact news, if we know for a fact that Wednesday, Thursday, and Friday, and even Tuesday are going to have the higher probability, the higher volatility. So then Monday is going to typically be some form of not necessarily consolidation, but it's going to be a tighter range compared to the rest of the week. And if you take the Monday from the low to that high and you measure using true day open, which is from midnight to midnight, and obviously not right now, but when the day's over, if you take the low of Monday and then you go into the high of Monday and it's a tight range, like you can determine if it's a tight range, just you can eyeball it. You can take that range and apply it into tomorrow's or the days where you're expecting higher volatility within that same week and add on to your distribution expectations. So let's say, for example, Monday is 100 handles. Yeah, let's just say this is 100 handles. Tuesday, now this isn't standard deviations, but it's very similar. If Tuesday's bullish and it trades down into there, let's make this different color red. If Monday, you can eyeball it and just say, yeah, that's a tight range. And you know Tuesday's going to have more volatility because of high impact news events or FOMC or whatever it is on Wednesday. Then you can take that Monday range, wait for the low of the day to form in Tuesday, and then from that low of the day, you can apply the Monday range as a low-hanging fruit objective for any long potential setups that you may have. Because you know it's going to extend beyond that Monday if you're familiar with the anatomy of, how the weekly range unfolds. Monday doesn't have high impact news, and then the rest of the week has high impact news, so you're expecting Monday to be the tighter range. And then if you just think about this from the aspect of a daily chart, the Monday daily candle is going to be really small, then the Tuesday, Wednesday, Thursday, Friday ones are going to be a lot larger. You can take a measurement from this, apply it to the low of the day, and then the high, say this is 100 handles. This orange box is 100 handles, that's Monday range. And then Tuesday range from the low, you measure 100 handles up. That would be a low-hanging fruit objective for any long setups you have. And then you can take a standard deviation of 1.5. So that would be here. And now that would be where you'd probably expect the daily range to distribute. Now, I'm not saying that's going to happen this week because Tuesday's unemployment claims is not FOMC, but I'm just giving you an example of when you can potentially apply that. And that's something you won't get in any private mentorship that you'll ever see on the internet. Free of charge. Okay, looking at our pre-market range. Oops. I'm not going to be with you for the entire session, but I do want to just give you my perspective on where I think the market may go. There's our pre-market low. There's our daily opening price. And there's our pre-market high. Now, we're in all-time high conditions. Inside of all-time high conditions, what bias do you want to use by default? You typically want to go in with a bullish bias. regardless of what's happening on the chart, you're not trying to pick the top. You're not trying to do what everyone on Twitter's doing. That's bullshit. You know, no one really knows where the top is going to happen. You can predict where or how far it could distribute, but you can't pick the top really. Even with certain projections, like you're going to have a very difficult time picking the exact top. You can pick where short-term highs may form, but expecting where a top of an all-time high market is going to form because you used a fulcrum, completely unreasonable, completely unrealistic. So you want to default to something like this. Say we deliver up into that high, we manipulate that high, and then in that macro we take out a pre-market low. Maybe we trade into our new week opening gap, and then I would want to see something against this. So I would want to see some kind of signature in the marketplace that tells me, okay, we should be going higher now. So some kind of market structure shift, short-term discount pricing, breakaway gaps, whatever it is. And you can refer to lecture number 10 and 11, where we go through market structure shift protocol. And then I would want to see something distribute beyond that pre-market high again. Is a pre-market low not the 7 a.m. low? Yes, it is. Yes, it is. Good eye. Apologies. Likely they will cut rates this week. Is trading before Wednesday advisable? Yeah, you can still trade. Yeah, you can still trade. Whether or not they cut their rates or they, I don't care what they do to the rates. Everyone's saying they're going to cut them. Couldn't care less. It doesn't affect what happens here. This technical analysis is all you need. 24,180. Yeah, it's been taken. Okay, let's look at okay, this is our new week opening gap. This is our midnight opening price. This is our 8:30 opening price. We had that medium impact news today, so keep your 8:30 open on. Keep your midnight open on. And then you really want to be looking at if we can trade into the new week opening gap low as well, or just a new week opening gap high, because we're in a deep premium relative to our daily range, but don't forget we're in all-time highs, so that doesn't mean it's going to trade below it, but you can have an expectation that, provided you have the narrative behind your trade, it should potentially reach into this, or discount pricing between the midnight open and the 8:30 open. Yeah, we'll see. Generally, if you're in a deep premium and then you trade in between the 8:30 open and the midnight open, you want to see something else that reinforces you trading below that midnight open. So if price is in deep premium, like it is here, above the 8:30 and the midnight open, and it trades below into here, you want to see something like a breakaway gap, or an institutional flow entry drill, or price reacting to the midpoint of an inefficiency, or an order block, or a breaker block, something strong that gives you the reinforcement that you should keep distributing lower below midnight. Yeah, it won't just be a straight shot down into the midnight open. Usually, obviously, market open can present some weirder circumstances. We're not going to do that. Okay, so here on our regular trading hours chart, liquidity on the regular trading hours chart is still salient and relevant to what's happening on the electronic trading hours chart, so just keep that in mind. My stomach is rumbling. Okay, so that's our 4:14 closing price and our 9:30 opening price. The gap size we'll refer to on the electronic trading hours chart is I draw this. I messed it up. 66 handles. So it's not a huge one. That means you want to see it filled in to at least the consequent encroachment level within the first 30 minutes. So just taking the pre-market high. The only difficult thing here is that you're in all-time high conditions, so you don't want to be selling. If I was in the market right now, and I've already done my trading for the day, so I'm not going to be trading now. I was trading the pre-market model earlier on gold. But, I'd expect something like this to happen. Potential trade, or not trade, potential move into our consequent encroachment level of the new week of the opening range gap. Again, you're in all-time high conditions, so be careful. I don't like selling in all-time high conditions at all. It makes me uncomfortable. Okay, looking at our liquidity, we're not going to have any buy side, and that's because we're already in our all-time high. So there will be nothing in terms of a liquidity pool to look at for buy side. So then what do you target? You can look at things like fulcrums. Again, we're not trying to pick the highest high or the lowest low of the fulcrum. We're just looking at somewhere we can expect price to reasonably distribute. And we're also not looking for tick-to-tick precision. It doesn't matter if it touches that with a perfect tick. You're just trying to capture the lion's share of the move. So the reason I'll use the London kill zone is because on a 15-minute chart, if you zoom out a little bit, you can see that it's it's a dealing range, it's fulcrum, where it takes out this high. It does take out the high just by a tick, I'm pretty sure. So the high of this candle is 24,159, and then the high of this candle is 24,159.5. So it's 2 ticks above that price, and it drops below, comes into this order block plus inefficiency. That's a good fulcrum that I can use to identify where price may or may not distribute. But generally, a fulcrum, again, you're not trying to pick the highest high, the lowest low, but you're just trying to figure out where the lion's share of the move is going to be. First presented fair value gap there. No, not yet. There was no high impact news today, so you wouldn't use the 929. Oh, sorry, the 930 candle. Well, I guess you did trade above the relatively equal highs there, so excuse me, I was incorrect. You can use the 930 candle today as a first presented fair value gap. I'll explain in a second. Apologies. So if you go to the regular trading hours chart, you'll notice that we opened up above the recent highs. Now, if you do that, you've basically broken out of that range, and that means you're able or allowed to use the 930 candle as your first presented fair value gap. Normally, in the normal circumstance where we don't open up above these relatively highs, or we don't have 830 high impact news, you would be limited to 931 and 10:59, or sorry, 11 o'clock. Those 29 minutes would be the only candles you can use for a first presented fair value gap, but you can use this today. Can you look at big figures doing all-time highs? Yeah, you can. It's just, personally, I don't really use them that much on indexes. I do use them on Forex, but, on futures index, they don't play as big a role from what I can tell, and I've just never really settled with using them on indices because I find projections better on index. But yeah, if you want to use institutional levels like the 20, the 80, and the 50, and the big figures as well, then feel free. Let's like the stream, everyone. Okay, currently, that is a breakaway gap. So if you ever see me annotate bag, BAG, that is breakaway gap. A breakaway gap is when price leaves the range and it doesn't retrace back into that gap. So it's essentially broken away from that range without returning into the gap. It's broken off. More likes equals more mods for the Lambo. I'm Lambo-less at the moment. Lambo-less. Okay, we're no longer doing the silver bullet mentorship, that's finished now, so I'm not limiting this to just the lens of a silver bullet. You can trade this however the hell you want to trade it. $9:16 AM low. Potentially. I would be a bit more ambitious though. I think you could trade back into these. If you look at this, we have a low, higher low, higher low, higher low, higher low, higher low, higher low. I guess that's a higher low, but it gets stopped out, so that's a lower low. And higher low. So this is trendline liquidity, basically. Now, I don't recommend using trendline liquidity as like a draw, but it's useful in just looking at where low resistance liquidity is. It kind of is just another way of drawing it. Relatively equal highs and relatively equal lows are going to serve best, in my opinion. Because you're essentially going against the majority of the trading industry that uses resistance and support levels, whereas trendline traders are a little bit, well, yeah, they're way less trendline traders. Pretty much everyone uses some aspect of supply and demand levels, or support and resistance levels, where they'll say that's resistance and that's support, but far fewer traders use this, a trend line. Way less, way less. AMD forming right now. Guess, yeah, AMD. It's not so institutional though. I am dumped. Oh yeah. I didn't mean to show those executions. Oh well. Okay, we're gonna wait for the macro before looking at really anything. I want to see this top out and then drop down below something significant. So even if this displaces higher into our second standard deviation of our fulcrum, but it leaves a fair value gap. So if it does this, and the first fair value gap before the stop run is of not necessarily a huge fair value gap, but it's of some size, and it gets inverted, plus it drops below the low that forms here, if there is one that forms, then I would like to see something deliver lower. Again, there's no sell trades for me today. I don't sell on all-time highs. I only buy it, buy it, buy it, buy it, buy it. this back. So it ran through the pre-market high there. The rule, by the way, that I gave you, or not the rule, the general occurrence that when the pre-market high is taken between 929, 930, and 931, it applies for a liquidity sweep, not a liquidity run, and that's with any liquidity event ever. You're not going to trade back into the opposite side of the range after a run, only with a sweep. So keep that in mind. Back into the order block. I like that we're putting in a low here. It matches my narrative that I mentioned a bit earlier. It doesn't need to dump right there. It's fine if it does, but I would prefer it does this, displaces higher, and with this low there, it creates a market structure shift. And then I could see some type of delivery into our opening range gap or our new day opening gap. We have passed through our new week opening gap quite a bit, so it's not as sensitive as one where you just cross through one time or you leave it after the Asian session, but it's still completely valid to see as a draw. Also, you'll notice I'm using the regular trading hours new week opening gap, so I'm not using the regular new day opening gap. That's because it's 0 with gap. So over here, our 6 o'clock opening price is the same as our 4:59 closing price. So that's known as a 0 with the gap, where there's just no range in between them. When you get a 0 with the gap, you then, instead of using the 4:59 candle closure and the 6 p.m. open, you refer to the 4:14 candle closure and then the 6 p.m. open. And that will give you something else. Some people say this is less accurate. It's not at all. It's absolutely the exact same. Generally, you can use the regular trading hours and your day opening gap exclusively if you want to, and you'll still get perfectly fine readings. I find that it's just easier using the 4:59 gap. You should never have both of them on your chart. It doesn't serve that much information. I have no idea what it's talking about. I just show up so I feel like I'm doing something useful. Pay attention. Maybe I'll If you have no idea what I'm talking about, then just go through the Silver Bullet Mentorship again. It's all free. Or just start with lecture 2 or number 3, because that's me stripping it back from the bare basics, showing you how to identify pools of liquidity, where price is likely to manipulate and where it's going to likely draw towards. It's not dumbed down, but it is a simple, or not necessarily simple, but it's easy to understand. That was the main objective. It's talking about how I bought my first lamp. 0 lambles. Okay, so what we're looking at there is the 936 order block, and then although the wick traded below the order block, we allow for the wicks to, color outside the lines, and the body closed above the mean threshold, so that's strength. And it's also because the wick colored outside, and then we traded back into an area of, or we closed back into an area of, the upper half where we expect it to react more bullishly. Then you can expect more speed because the wick came down, took out whatever trailing stop loss there was, and then it respected the PD array's key level. It would have been nicer if it did something like this and it went below that low, because then you could make the argument that it stopped out people who were trailing their stop losses way too tight. In other words, scared money. If you're trailing your stop loss too tight, you're referred to as scared money. But it doesn't actually stop them out, unless there's an SMT there. Let's check. Oh yeah, there is. So once again, he's correct. Yeah, thank you, Zach. Why are you always dropping these long videos? Are you ICT? I am ICT. Oh, mind. That's nice because it's leaving behind, even though it's little, relative to the candles around it, it's not so little. Bounce price range. So there's overlapping inefficiencies there, meaning there's two overlapping fair value gaps. It doesn't matter that it's so tiny because the candles around it aren't exactly huge. It's about 10% of the candle range, so it's fine. And then not trading back into that bounce price range gives you the idea that it's about to move off with speed. So that second standard deviation of the fulcrum looks like it aligns with 1.5 standard deviations of this one. Yeah, pretty well. So that's a nice little target if you're in longs. How is that bounce price range? Also, isn't that also an inversion fair value gap? Yeah, it is an inversion fair value gap. But a bounce price range is overlapping inefficiency. This is one form of bounce price range. There's many, and you treat them all differently. But look at this inefficiency, and you look at the one on the left, and then you draw it until it's only got that one-sided delivery. So one-sided delivery down, one-sided delivery back up. That's bounce price range. Talk about your morning trade. It was just a pre-market model. I'm saving it for private mentorship now. Yeah, I need to produce a lot of content for that private mentorship. A lot. You should include those examples that T-Trades does in their videos when they show it's an XYZ and what isn't XYZ and give them live examples. Yeah, I've already done that. Way ahead of you. But T-Trades does it with like market structure shifts and order blocks. I'm doing it with an entire model, so it takes a bit longer. But I've already made quite a few videos for the pre-market model in the private mentorship. And then classic buy or sell day I still need to record. That'll take a while. Because I want to teach it from the ground up, like introducing power 3 concepts, and then how you could potentially spot them and stuff. So, okay, that's our second standard deviation reached. Yeah, nice. From the London range. Again, you're not looking for these to pick out the highest high or the top or the lowest low. You're just looking for the lion's share of the move. So I outlined earlier that with a trade, sorry, with this low being put in, if we can go back into the second standard deviation, and then we can invert a fair value gap like this one, and then get that market structure shift, then I would really like, or I would really expect, if we trade below this, to fill in down to our pre-market low, and potentially our new week opening gap. I haven't watched any videos yet, I'm still finishing the 2022. That's fine. Wait, you're still finishing 2022? It's been like a month. Come on, man. Still deciding what to watch after 2022, maybe the 2016 or your Silver Bullet Mentorship. I'd recommend the Silver Bullet Mentorship. And that's not biased, that's just if you've already got 2022 and you understand it and you're looking for a model, then the Silver Bullet Mentorship will serve you well. Serve you very well. I was busy with moving and so I'm getting, yeah. Excuses. Sure you are. I'm joking, by the way. Okay, I want to see something inverted here if we're looking for lower prices, and then not that I would trade it lower, I just want to see it go lower so that I could potentially enter longs. You won't see if I do, by the way. I'll be doing it on my phone. I don't want a paper trading account here. This isn't my live account. I can put on 1,000 contracts right now, and it means nothing. It's a demo. But it could just keep rallying. We're in all-time highs, so you never know. Okay, if you zoom out on your hourly chart, and then you come down to August the 28th, and you're looking at it from September the 5th. This tool. We were talking about this when it was occurring, actually, but a little bit of work on aligning yourself with a market maker model. Doesn't matter if this is on the hourly chart, pretend this is on a 1-minute chart, and then you're looking at a silver bullet trade. Well, there's your market structure shift, and there's your fair value gap that gets inverted, or the displacement through the market structure shift. So that's a strong breakaway gap because you displaced through, and then you're not really looking for that short-term discount pricing after you've already displaced through. If you just sweep the market structure shift, then yeah, you would look for something short-term discount like this fair value gap, and then potentially buy that going into the original consolidation highs, or these highs. But with the breakaway gap, you can just enter on the breakaway gap, or like whilst it's trading away from the breakaway gap. And then this little portion of price action, that little thing, you're spending 1, 2, 3, 4, 5, 6, 7, 8 candles there. On a 1-minute chart, that'll be 8 minutes. Relative to the delivery of previous price action where you're getting these big candles, that's a relatively small range for the amount of time you spend there. So this is a large range, that's a small range, that's a large range, that's a small range, large range, and drop it into that small range. That small range is acting as a balanced price range. So some people will say, oh, that's a fair value gap. It is, but you're looking at the price action inside of that fair value gap, and this portion of price is balanced. To trade through a balanced price range, if you're bullish, it's very difficult. So if you had dropped into here, you could have a safe entry there with a stop loss right below the low, because in a balanced price range you shouldn't be trading through it if you're still bullish. That would be a protected low, or a form of protected low, not the standard case, but you could see that as a protected low. So if you're looking at silver bullet, and you're matching it up with your market maker models, even if you're not familiar with market maker models, if you just understand that you have consolidation, then you have a reversal, and then you have a low risk buy or some kind of accumulation back into the original consolidation, align yourself with each side of the market maker model. So that's the sell side of the curve. What you want to do is look at the buy side of the curve. So once you've formed out the sell side of the curve and you're expecting distribution higher, that's where you can get silver bullet entries. Obviously this is a 1 hour chart, but applied to a 1 minute chart, it's the exact same thing. So in the sell side of a market maker model, are you looking for a trade? You can if you're advanced, but for now let's say no. You manipulate a low, like you do in the silver bullet, take out a low, market structure shift, fair value gap, but you displace through it. What can you reasonably expect after that now? You can expect a trade into the original consolidation highs. So that would be a market maker buy model, and your silver bullet happens at the area known as a low risk buy. So this is known as a low risk buy. That would be a silver bullet entry. That would be a silver bullet entry. Technically that could be. I should have done this in the actual mentorship. So when you're looking at this through the lens of a market maker model, it makes it easier to frame how far it's going to go, like how far is price willing to go. Well, you have the new day opening gap there. You have all these inefficiencies that you end up overlapping. Use them as support to go higher. When you confluence a silver bullet trade with a market maker model, you really put yourself in a great position to, start predicting where it's going to go. And a silver bullet, the idea behind a silver bullet, sorry, not silver bullet, the idea behind a market maker model is you're getting all of this narrative. If you were just looking at this individually, like that, now it looks like bearish order flow, and it is. But then when you're looking at it through the lens of a market maker model, you're seeing where you're likely to get, trade opportunities. Like here we have a silver bullet. That was completely irrelevant. I don't know why I went on talking about that. Okay, we're inside of the macro. Distribution macro. Notice with the fulcrums, the fulcrum projections, every time we trade above a standard deviation, and I don't have any more, am I going to start just adding more and more and more? No, because then you could just keep adding them infinitely and say, oh, it's because of the fulcrum, it's because of the fulcrum. And that's, you're just putting random lines on your chart at that point. With a fulcrum, you're using the 1.5 and the 2 standard deviations. Now, it depends on the size of the fulcrum and the range you're working within. Sometimes you'll use, you'll skip to 0.5 and just go to symmetrical moves. So, second standard deviation, third one, fourth one. When it's something like this, relative to the range that we're working within, I'll use 0.5. So 1.5, 2, and then 2.5 is something that we can potentially reach into with a couple of wicks. But I'm not looking at that for, a realistic objective. 1.5 and 2 are going to be realistic objectives. So this will just help you get more onto your trade. I discussed this in the workshop yesterday, the silver bullet workshop. You're not extending the standard deviations infinitely. You're just looking at the first couple. So 1.5 1.5 to 2.5, or in an extreme case where you have a smaller fulcrum in a larger range, you would use 2, 3, and 4. If you're just looking at a 15-minute chart, doesn't it look reasonable to potentially wick into that 2.5 and then trade back below this? It does to me, so we'll see if that plays out. It's not a clean fair value gap. If it was a clean bigger fair value gap and it traded underneath it and below this low, and it looked like a sell bullet trade, that would be nice. But it's not super clean. There's no gap there. So consolidation is a bounce price range. It depends on the consolidation. But generally, yes. However, you don't treat it the same as overlapping inefficiencies. So I just realized I was muted. Yeah, so the consolidation bounce price range isn't going to be treated the same as two overlapping inefficiencies. You can have, okay, this may be confusing, so if it is, just ignore what I say, but this is the bounce price range. That's one form of bounce price range. Overlapping inefficiencies are a form of bounce price range. Consolidation is a form of bounce price range. But they're all treated differently, slightly, not a huge amount. Well, I guess it is significant enough that you need to know the difference. But private mentorship material, it's not necessary to be profitable, so you don't need to know it. I like that we left the volume bounce there and then we traded into it and away. That's nice. Again, not looking for sell trades, just reading the tape. Are you hungry? Yes, I'm hungry. Why? You always say you're hungry around this time. Yeah, it's because I don't eat in the morning. I've been eating once a day, but then I have snacks around, this time to 4 o'clock. Like I'll have tea and biscuits. And then at night I'll have a big meal. That's a recent change I made because, I've been doing it for like 20 days now. I just had digestive problems. Plus it's hard to focus when I eat. I don't know why. Just feel lethargic, slow. But now, when I'll skip breakfast mostly, or I'll have like tea and a croissant or whatever, something small. maybe like a toast, and then in the day, around 3 to 4, I'll have tea and biscuits, and then at night I'll eat a big meal after training. It's nice though because it feels like I earned the food. It feels like I've done the whole day of work. I've been training. I've been productive. Now I get to eat. Yeah, I like it. But you do get a rumbling stomach every hour. Do I use a silver bullet or take trades during the silver bullet hours? Yeah, I do. Uh, I'll be reading this, and then like even in past live streams, just because I'm reading tape with you doesn't mean I'm not trading. I'll be on my phone and I'll take a position, and then occasionally I'll share it as well. But um, I'm not trading this, by the way. I've already done my trading for today on euro dollar. I do my forex positions on C Trader, so they're not here. Yeah, classic buy day. But no, I do use silver bullet quite quite a bit if I'm trading London or if I'm trading the PM. I'll be doing silver bullet or I'll be doing classic bias all days, and then during the New York AM, it's it's either silver bullet or it's something to do with the daily profile. So if I'm expecting New York to be a continuation of London, I'll position myself in the pre-market and I'll hold through the AM session into some kind of objective. If I'm expecting it to act as a continuation of the London session, if I'm expecting a reversal profile, I'll treat it completely differently and I'll probably stick with a silver bullet. It just depends on the day, it depends on the economic calendar, it depends on what price action is showing me, depends on the kill zones. Uh, yeah. So I have a pretty in-depth of bag of models. Yesterday I was trading Asia. Well, not Asia. I was trading the Open. So I got in long there. I took a partial above here. I know it looks tiny now, but I posted it in Discord actually. Uh, it was like $500, and then I got stopped out in profit around there, I think, or there. Or was it? It was here. It was here. Then it went and manipulated the sell side, but I was asleep, so I didn't catch the buys into the major buy side. I posted this in Discord, by the way. The setup with the major sell side, the initial sell side, initial buy side, and then the New York PM liquidity, which ended up getting reached during London. You have a few models. I would like to backtest one. How about you backtest video of Silver Bullet as you're already teaching it? Thank you. Well, the Silver Bullet mentorship is actually done now, so I'm not going to be really doing much of that. I could make a backtesting video on it. Maybe I will. But for this week and probably for next week, I need to focus heavily on the private content. But the YouTube's not changing at all. There'll still be some live streams. There'll still be weekly outlooks and not daily reviews, but market reviews and daily analysis in the Discord. Nothing is changing in the free stuff. A backtesting video I could do. Maybe I will. I'll add it to the list of 100 videos that I have to make. Okay, so you might think that it's looking like it's using this standard deviation as support. I can see that, but I wouldn't be using this as a support or resistance level. It's more of an expectation of where price is going to distribute. So you're not really looking at this as something to take a trade off, like a support and resistance level. You're just using it for, again, distribution expectations. How far is price willing to go? That's what I mean when I'm using these fulcrums. Well, I'm almost never referring to them like if we've already gone through it. I don't write them off completely, but I'm not using this to sell off of. It's not a PD array. It's just something you can use to predict how far price is going to go. Mm. Monday should have a tighter range. Could it be seeming or trace? Yeah. That's why I'm looking at the open range gap. We are outside of the 30-minute window. That doesn't mean this won't get filled in. Sometimes this will just be delayed. It has a higher likelihood of getting filled in during the first 30 minutes, but those chances don't drop off through the rest of the day. It's just that in the first 30 minutes, there's a 70% chance of the consequent crush level getting filled or being traded into. Depending on the gap size, it's not going to be with every opening range gap, but with a smaller one, where, it's not small, but it's 66.25 handles. So yeah. So this is the first fair value gap that formed after the all-time highs are run. It's a very significant fair value gap. You want to see that inverted if you're bearish. I wouldn't use a market structure shift here alone. I would want this inverted first. Even it doesn't need to be inverted on the 15-minute chart, even though we got it from the 15-minute chart. It can just be inverted on the 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, doesn't matter. Again, I'm not selling today. Not in all-time high conditions. I'll wait for a sell-off and then trade back against it on the long side, but I'm never on the short side in this condition. 1020 macro then drop. There is no 1020 macro. Not a 1020 macro. Not that I know of. Well, not an ICT macro. Reason being, I want to see an inefficiency created off of that, and then I would use the order block, just because being in close proximity to this valley gap, this could potentially deliver back into these engineered highs. So I want something resembling displacement lower, and then ideally no wicks. Yeah. So if we get an inefficiency here, even if there's one displacement candle and then it immediately rebalances it, then I would place more emphasis on the order block. But until then, it's kind of sit and wait. Not that I'm going to be trading it, just, 10:06 a.m. opening price. That's not an opening price, though. That's just a random candle. Do you think silver and mentorship is enough to be profitable? Absolutely, absolutely. Yeah, we go through everything in there. The prologue video is me doing it like properly, me putting everything together, and then I strip it all the way back to just liquidity, just the concept and purpose, and then identifying where it's likely to manipulate and draw towards. And then we start adding in things like the opening gaps and opening prices and dealing ranges and opening range gaps and displacement, all supporting displacement. And then in the price action workshop yesterday, we covered optimal trade entry and fulcrums and applying it to Forex. So there's pretty much everything you can need to be profitable in there. So yeah, you'll be fine. If I can only choose two pairs to trade silver during London, then what pair do you suggest? Nasdaq and Eurodollar. Eurodollar's nice. Yeah, Sui's correct. Yeah, or the pound dollar. I prefer the Eurodollar, but pound dollar is perfectly fine for the London session. Okay, so we haven't got that displacement that I wanted. So it's not that I'm ignoring the order block, it's just that trading back into it doesn't fill me with confidence. There's not that much to do right now. Euro yen might work also. Haven't done backtest, still trading on it though. It could. I don't like the yen pairs. ICT said he doesn't like them, and then I was like, why doesn't he like them? And then I went into them, and they weren't that good. So yeah, they just move kind of. And last video, you said the core hours of London is 2 to 4 and could extend to 5 a.m. if the first 2 hours of price was not expansion. The ICT said it's 3 to 4 a.m. Yeah, the silver bullet hours are 3 to 4 a.m. But you can add on the macro times, so you would go from 2:50 to 4:10. The London kill zone, not the silver bullet hour, the kill zone is from 2 a.m. to 4 a.m. and then extended to 5 a.m. So to trade silver bullet, I need to watch chart from 2 a.m. Well, if you can get to the chart at 2 a.m., it's good. But if you can't, or if you just don't want it, then it's fine if you get there at, 2:50, and then you're there for the macro. You see how the macro delivers. You see what the stop hunts are, and then you're watching it live, so you get the bigger picture easier. Whereas if you just get there at, 3, it's fine, but it's better to get there at 2 and then watch it form live, because you can form the narrative in your head a lot better. But I understand not everyone has the time for that, so just do whatever fits your schedule better. It can form before 3 a.m. At around the 250 macro is kind of where you want to limit yourself to your entries. You're not really looking for any trade. This is the downside of living with family. Anyway, you're not looking for trades before 2:50 a.m. You're just looking at anything post that. Yeah, but the kill zone is 2 a.m. to 4 a.m. and then extended to 5 a.m. if there's no move between that 2 to 4 a.m. window. Yeah, I'm getting used to it. It's fine when I'm trading alone, it doesn't bother me, but when I'm on stream, it bothers me because I'm trying to talk to people. Or if I'm doing a video, it's fine, I can just edit it out. But on a stream, you can't edit it out. So I just unplug the mic and plug it back in. Price is so lethargic. Yeah, it really doesn't want to move. It's kind of bouncing between PD arrays. There's no one-sided displacement here. So you just chill, sit on your hands. Okay, we'll see how the 15-minute candle closes, and if it closes above here, it's real nice, but I don't think it will. But it is setting up a potential bullish order block for the next candle. So we'll have to wait and see for that. It's almost like I knew it wouldn't deliver. Interesting. I'm gonna give it a couple minutes and then I'm probably gonna go because I'm so hungry, man. And yeah, I've done all my trading today. I'm just here for you guys. Thank you. I appreciate you guys too. Okay, so that is low, high, low, high, high. So this bearish order block becomes a bullish breaker block. Why did I say it's high probability? Or not high probability? Again, because of the fair value gap and a lack of displacement away from it. Rick, do you have private mentorship? Well, not yet, but towards the end of the week or Monday next week, yes, there will be a private mentorship. It's cheap though, it's 75 a month or 365 a year, which if you do the monthly, it's going to be a bit more expensive, but if you do it for the year, it comes down to $1 a day, which, amazing deal. Amazing deal. I'd pay to be in my own private mentorship. Yeah, I just need to finish recording some of the content. The pre-market model's covered in there. I've already done quite a bit of content this morning. And then I need to do a few more models, so I'm going to be teaching the classic buy or sell day in there. And then there's going to be an Asian model. And silver bullet, there'll be stuff on the London silver bullet that I haven't covered in the free stuff, but you don't need it to be profitable. So if you're looking at silver bullet, you can just go through the silver bullet mentorship and you'll have all the success you need. Yeah. There'll also be daily analysis, daily reviews, a bit more of an intricate weekly outlooks where we go through intermarket relations as well. So the free section is not changing at all. You don't need to worry about that changing. Trading camp's the exact same. And the YouTube channel's not going to change much. There's still going to be weekly outlooks, there's still daily analysis, there's still pretty much everything except for the silver bullet mentorship, because that's finished now. There'll be occasional tape reading live streams, like today. What's the first model used to be profitable in the past? It was optimal trade entry. Back then I was doing exclusively Forex, so I wasn't doing futures then. Yeah, it was just optimal trade entry. But it wasn't on a 1 minute chart, it was on the 15-minute chart. I was scared to go on a 1 minute chart because everyone was like, oh, it's noise. And for a beginner, I wouldn't even recommend a 1 minute chart unless you have a specific fixed model like the silver bullet. If you're looking at optimal trade entry, should you be going down to a 1 minute chart? I wouldn't recommend it for a beginner, no. But when you have those specific parameters like a silver bullet, then it's fine. But if you're trading a bit more loosely, then I'd recommend something on the high time frame, like a 15-minute or a 5-minute or an hourly, something like that. And for beginners, on a 1 minute chart, you can get really caught up over leveraging and over trading. Whereas with a 15-minute chart, you're very limited in what you can actually do in terms of over leveraging. So you give yourself that little barrier. And I think a beginner that isn't using a fixed model, because you can be on a 1 minute chart and be doing just fine. As long as you have those fixed parameters like we have in the silver bullet mentorship. But if you don't have that, then something on the higher time frame, I believe, is going to serve you better. It was a very simple model. It was just align yourself with high time frame bias and then enter on recent supporting displacement. So say you have a higher time frame is bullish, and you get a straight up delivery to the sell side, and then you trade up above that. You would look at optimal trade entry of this leg, and then you'd enter this. The thing is, it was quite rare that you'd get into a trade, so it took a while. And I was only looking at the euro dollar then, I didn't even look at pound dollar very much. But then I started looking at other pairs, and I could use that model and still find any more trades. So like that. We'll be chatting about psychology today. will I be chatting about psychology today? Nah, I'm good. I'm good. Maybe tomorrow. It feels weird doing it in front of a chart. I feel like I could do it on a blank screen, but when I'm looking at a chart, uh, yeah, I don't know, it feels weird. So that thing that I just outlined, that model, high time frames bullish, right? We're in all-time highs. What's that? That's a state of delivery to the sell side. And you get supporting displacement, like that. And the optimal trade entry level, there. So, but I'm not telling you to buy or anything, I'm just saying that on a daily chart, or on a 15-minute chart, or on an hourly chart, or something like that, that's where I would have taken a trade. Okay, I'm gonna call it here, and I'm gonna go get some food. Yeah. Hopefully you learned something. At the very least, if you joined a bit late and you're not sure about how contract rollovers work or about this week's economic calendar, then go back to the start of the stream and it's all done there. I go through pretty much in the first minute how the contract rollovers work and expiration dates and when you were going to roll over into the next contract, and that's going to happen this week. So if you haven't seen that and you don't know how contract rollovers work, make sure you watch that bit. Yeah, that's it. I'll see you in Discord.